Hello, I'm Chip Stites, and this is the Laughing Retirement. But today we're going to talk about something I've been reading a lot about in various newsletters and in the paper, et cetera, et cetera. The R word. Nobody likes to use it, but it's kind of strange because it all it means is a period of two, at least two quarters in which we have no positive gross domestic product. In other words, there's no positive output. It's a negative output for a couple quarters. Now, you got to understand that when we look at a recession, we talk about that. Everybody freaks out and goes nuts, but you really don't have to, and that's part of what I'm going to show you today. But a lot of times a recession happens, comes and goes before we even know it. Because first of all, everything gets reported at the end of the quarter. So the first quarter is already passed when you get negative gross domestic product. And then you got the second quarter and it's already passed. Now you've got two quarters. Now you've got a recession. But very often it's done. And we don't hardly realize that we're in it. And that happens with a fair amount of regularity. So why do we worry? Well, we worry because of all the hype and all the things that people tell us we should do for the recession and all the worry that you're supposed to have about you losing money. It's like I listened yesterday to somebody talk about how Trump was responsible for losing $12 trillion in the market. Well, presidents are almost responsible for nothing that happens in the market. I mean, we're watching gold climb to new all-time highs almost on a daily basis, and here we are blaming a president for something. Gold's been going up for a while. It's been going up for a while because there are a series of problems. Period, end of sentence. We have wars. We have issues with inflation. We have a big debt issue that needs to be solved, where somebody's going to solve it for us, and we aren't going to like that solution. We've got so many things that are going on right now that the easiest thing to do is say, well, it's tariffs. It's tariffs. It's the president's problem. He did this. It's tariffs. Well, that's like looking at a 1,500-piece puzzle and saying, well, this is the last piece. This is the piece that goes there last. You don't know that. You don't even know what piece goes in there first. And you don't know how they all fit together. And most of us don't. And that guy I listened to on television last night, Ford, is reasonable in his thinking. But to take everything and blame a possible recession and blame all the problems we're having on administrative changes, hell, I've been listening to that for 45 years. And it's just not true. Because our economy goes through cycles. Now, are the cycles influenced by what the Fed does and what banks do? Yes, they are. That is obvious. At the same time, we don't have to worry because we're going into a possible recession. And so I want to talk to you about understanding the sectors and how you can manage risk using sectors, and why doing all this is not a reason for worry. Why your recession should be a reason for worry. If you have a portfolio that's put together properly, you don't have to worry about the Fed. You don't have to worry about tariffs. You don't have to worry about wars. You don't have to worry about anything. Because the idea that you need to shuffle things around all the time when nobody knows what the future will bring just doesn't make any sense. So let's take a look at sectors, because they do make sense. Now, the sectors of the S&P 500: communication services, consumer discretionary, consumer staples, energy, financials, healthcare, industrials, information technology, materials, real estate, and utilities. All of those 11 different sectors of the S&P 500 are a group of jobs that have things in common. That's what a sector is. Now, communication services should be relatively obvious. We're going to find communications companies in there. Now, to name a couple, I don't know, Verizon, AT&T. That's the type. We're also going to find digital data centers in there. We're going to find stuff like that in information technology. We're going to find shipping and industrials. Consumer discretionary, that's what a consumer can buy when they have discretionary money. It's not something you have to buy. Consumer staples, those are things you have to use. Food comes to mind immediately. Energy, turning on the lights or heating the house, comes to mind immediately. Financials, banks, healthcare, going to the doctor. Now, I just went through consumer staples, healthcare, and the last one is utilities. You go in, you turn on the gas, you turn on the lights, bingo, utilities. Those things we use all the time. Food, consumer staples, utilities, heating, cooling, and lights for the house, and healthcare. We're going to go to the doctor. And so those three things are considered defensive sectors. So having things in those three sectors is a good way to lower your risk. Excuse me. It's also a very good way to give yourself some excellent dividends. Now, dividends are generally paid out by companies that have been around for a long time, and you can count on them. And we're going to talk more about that. But if you're looking at the defensive sectors, they also have a tendency to have higher dividends. So let's define the sectors. Well, defensive, we've already talked about that. You're going to use this service or commodity regardless of economic health. Consumer staples, food, healthcare, going to the doctor, and utilities, turning on the lights in your house. They're all there. Now, moderately economic sensitive. These are economic sensitive sectors which react to various things in the economy. For instance, financials and real estate react a lot to interest rates. Now, it should be obvious why. Rising interest rates will favor a bank because they can charge more. Rising interest rates will, at least temporarily, not favor real estate because they have to charge more, so it's going to cost more for that mortgage, isn't it? Materials. These are things that comes out of the ground. Now, when business is going well, they need things. They need lumber. They need iron for steel. When the business cycle is picking up, they need those kinds of things in order to make the business cycle continue. Now, the most economically sensitive sectors are industrials, large companies, large industrial conglomerates, steel companies. Information technology, IT, we know about that. NVIDIA comes to mind immediately. Consumer discretionary, automobiles, these are things we buy when we have the money. And energy, things we will use all the time. They are economically sensitive because when we go into an economic downturn, people will use less energy because we're taking less out of the ground, because we're using less oil, because we're growing slower. So there are the three types of sectors that we are looking at in the S&P 500, the defensive, moderately economically sensitive, and the economically sensitive cycles, the economically sensitive sectors in the S&P 500. Now, size does make a difference. So the largest of those sectors, infotech, healthcare, and financials, that makes up over 50% of the S&P 500. So you can see financials and healthcare and information technology, some of your biggest companies immediately. Again, Verizon, AbbVie come to mind, AT&T, our large banks, Morgan Stanley. Those are financials that are large companies and therefore make up the largest three sectors in the S&P 500, information technology, healthcare, and financials. Now, mid-sized companies. Communication services That's pretty obvious. Again, we've talked about AT&T, Verizon, consumer discretionary, automobiles, industrials, and consumer staples. Now that represents 36.7% of the S&P 500. Smallest sectors, kind of surprising. Energy, utilities, real estate, materials. That makes up 12% of the S&P 500. But at the same time, the smaller sectors often have, for some reason, have higher dividends. And that's one of the things I have noticed, because a company which gives out dividends is not trying to make it grow. It's trying to give back to you some of its earnings. And that's why we want to own them, because that is less risky for us. Now, 1 year return. I wanted to look at just a 1 year return of the S&P 500. 1 year. Now, I wanted to see, and I just picked last year because it seemed to make sense. I wanted to see, okay, if the markets went up, did it go up where the economically sensitive sectors were the ones that made the most? What happened to the defensive sectors? Well, look here. The one that made the most last year is utilities. The second one in a moderately economic sensitive area is financials. The third one, am I right? Moderately? Yes, moderately economics is financials. Now, consumer staples. Again, the top three are things we know well. Consumer staples, this is food. I always like to point to CALM, Land O'Lakes butter, or Eggoland eggs. Well known. Financials, Morgan Stanley, utilities, Duke Energy. All these are well known. Now, communication services next, consumer discretionary, info technology, real estate, and industrials. You'll notice that utilities, consumer staples, and all of a sudden I can't remember. Utilities, consumer staples, and healthcare were not all positive. So it is good to have a full panel of the S&P 500 sectors. You don't have to have them all exactly the same weight, and I'm going to show you mine here in a second, because I orient the things that I have based on dividends, risk and dividends. That's what I'm interested in. I don't want to take a lot of risk, but I want to be paid a lot of dividends consistently, so I don't have to think about it. Now, let's go here. Recession investing, in other words, changing your portfolio for a recession, is just plain unnecessary. Let's take a look at the last quarter that went down for a while in the first quarter of 2020. What were the stocks that did the best? Well, info technology had 3, real estate had 2, healthcare had 2, communication and services had 2, financials had 2, and consumer staples had 2. Now, you will notice consumer staples, you'll notice healthcare, and you'll also notice, what's the last one? Come on. Let's go back here. What are the defensive sectors? Consumer staples, healthcare, and utilities. Now, do you notice anything about those years? Consumer staples, healthcare, and utilities. Well, 2 of them did pretty well. 1 of them did not do very well. And if you look at here, there are no utilities here, are there? So having a broad group of sectors represented in your portfolio and having enough dividends from them and keeping your risk low is imperative to not having to change your portfolio every time somebody says, oh, this is going to happen. First of all, they don't know. Nobody knows. Second of all, every time you make a change, it costs you money and makes somebody else money. The enemy of the equity investor is expenses and emotions. Warren Buffett. Expenses are what you create every time you trade. Emotions are what make you trade. So let's think about that. Let's turn this into a process instead of an emotion, and let's get rid of the expenses. So let's keep going here. Is it different this time? I've heard, I hear that all the time. Oh, it's different this time. This time it's the tariffs. That makes everything different. It's different this time. We've got a possible war. That makes everything different. It's different this time. We're fighting with China. That makes everything different. No, it's not. You know, over the last, 1400 years since we've had money and an understanding of money. I think it was the Ottoman Empire that brought fiat currency or currencies with no value. The Ottoman Empire brought it in from China, who they were trading with. China was doing it first. It's not any different this time. As the old saying goes, there's not much new under the sun. So regardless of today's situation, if you have low PE and high dividends with lower risk or lower betas, in the long run, you're going to outperform. And not only are you going to outperform, you're going to do you're going to make less effort in order to outperform. So what's the key? Well, the key is very simple. And I keep saying this to people all the time. The key is taxes plus inflation plus the cost of investing plus 1 to 3%. That's the formula. That's the formula. That's the only formula you need to understand in order to manage your money. Taxes plus inflation plus the expenses of investing plus 1 to 3%. If you make those taxes, inflation, and expenses of investing plus 1 to 3%, if you make 1 to 3% more, you're winning. You don't have to beat the S&P 500. You don't have to beat an index. You don't have to beat Wall Street. All you have to do is taxes plus inflation plus the expenses of investing plus 1 to 3%. Now, you can eliminate the expenses of investing. What does it cost to buy a stock? What does it cost to have that dividend reinvested? Zero. What does it cost to buy a stock and have that dividend sent to you if you're in retirement? Zero. If you own a mutual fund, that dividend costs you money. If you owned an ETF, that dividend from that ETF costs you money. If you own a stock, that dividend does not cost you any money. Now, let's keep going. Why is it good to have dividends during a recession? Well, first of all, I am more likely to get a dividend payment than I am to have the price of an investment rise. I like more likely. I like consistent. Now, dividend increases are more likely even when the market is falling. For instance, between 2008 and 2009, roughly 63% of the companies that said we're going to raise our dividends actually raised their dividends. 63%. So while the markets were falling apart and down 30 to 50%, the vast majority of companies that said they would raise their dividends, even in a bad year, still did. Even in a market meltdown, still raised their dividends. Why is that? Because often companies already have some or all of the money set aside for dividends. Because believe me, if you're investing in a dividend stock, the last thing that board of directors wants is to cut that dividend and have you sell their stock. They understand that. They know why you're buying the stock. That means that you and that board of directors are more closely aligned than you and the board of directors of NVIDIA or Tesla or Alphabet or Meta or any Tesla or any of the Magnificent Seven. Because these guys are paying you their hard-earned money. I want to get paid for the risk I take. Does any of this happen during a recession with growth stocks? No, it doesn't. And I'm going to show you why it is so important not to have your portfolio drop as much as the S&P 500 or the other indexes do during a bad year. Now, is dividend investing cool and sexy and fun as growth stock investing? Well, to me, it's even more fun. Now, you're looking at an upside down picture here because it's supposedly cool and sexy and makes a lot of sense, and you can see everything clearly when you buy a growth stock. When you buy a dividend stock, it's kind of like watching grass grow. So I wanted to turn your world upside down. I wanted to show you that I would rather watch grass grow or paint dry than I would try to guess the future. Because I know the grass is going to grow and I know the paint is going to dry. I don't know what's going to happen in the future. So let's turn your world upside down. Let's watch what is maybe not as cool and sexy as the latest growth stock. It's going to put more money in your pocket. Now, the diversification of my portfolio. You can see here that I have all 11 sectors. I don't have a lot in all 11 sectors. You can see that I have more in utilities and I have more in energy and I have more in real estate. I can tell you why. You can look at my dividend, 5.63%. That's why. You can see that information technology is a small number of stocks. Healthcare is a small number of stocks. Financial, larger number. Consumer discretionary, materials, industrials, large number of utilities, some consumer staples, energy, and communication services. And I have about 20% fixed income. Now I have those in preferred stocks as opposed to bonds or CDs or money market. My fixed income is also earning me income and giving me lower taxes at the same time. But all of that's in the course. That's somewhere else. So this is my portfolio. Now, why would I spread it out like that? Well, I spread it out like that because I want it to react. I want my portfolio to react slower than and lower than the S&P 500, but to pay me a lot more. So my risk is 65% of market, give or take. My dividend is 5.63%. My dividend growth rate is 9.9% a year. That's how fast my dividends are growing. Considerably more than inflation, taxes, the expenses of investing, and 1 to 3%. I want to get a larger paycheck every year. And my payout ratio is 62%. And what that means is that my companies can afford to continue paying me for a long, long time. Now, why Warren Buffett says don't lose money? Warren Buffett says don't lose money because it took me a while to figure this out. It is harder to recover when you lose money than it was to make it in the first place. So we're going to compare 22 and 23 together, 22 a bad year, 23 a good year in my portfolio. And we're going to look at why market drops are more significant than market increases, and yet we look at market increases all the time because we want to forget about those drops. No, because if you do it right, you can make a lot of money in the drops. Here we go. Now, these are the indexes. So for 22, the S&P was minus 18. In 23, it was 24.6% for an overall average of 3.25. The NASDAQ was minus 33, and then the next year plus 43 for an overall average of 4.8. The Russell 2000 was minus 21, then plus 15 for an overall average of minus 3. And the PIPE portfolio was plus 3.8, plus 0.2, 0.2 for an overall average of 2.03. Now you look at that and you say, Chip, you're not doing too well. I mean, seriously, you're number 3. You're number 3 out of 4. What are you crowing about? Well, I'll show you here. Always do the numbers. See, one of the things I was taught incorrectly, I was taught to use percentages. But if you use actual dollars, people understand it. And percentages can be very, very misleading. So let's take a look. If I had $1,000 and I put it in the NASDAQ in 22. I lost 33%, which means I had 662.60. And the next year I made 43%, which means I made $287. You put those two together and I have 950 bucks. So after a good year and a bad year, I lost 50 bucks. Let's look at the S&P 500. It lost 18% the first year. It gained 24% the next year for a total of $1,020. So the NASDAQ, which takes more risk and has more volatile stocks than the S&P 500, lost money compared to the S&P 500, and the S&P 500 made more, even with a bad year and a good year. Less volatility is better. Now, pie, taking less risk than the S&P 500, about 35% less risk. In 2022, I made 3.3%. In 2023, I made 0.2%. For a total of $1,036. Now, I hope that in a very simplistic way, this proves my point. Don't lose money. That's rule number one. Because it's harder to make it back than it was to lose it, it was to make it in the first place. So you want to take less risk and get paid for the risk you take. And I have found this to be consistent during bad years and even sometimes bad quarters. And I have shown you in my masterclass how my students have done, even when they didn't do as well. I've shown you the good and the bad of everything. Now, here you go. This is how the index, pie did versus the indexes in 2022 and 2023. Pie beat them by a total of $16. But it beat them. And over you hear, you can't beat the S&P 500. Well, I think you can if you do what the masters say to do, which is buy low PE stocks, PE stocks with less risk, and stocks that pay you for the risk you take, high dividend stock. That's where we are. I use individual stocks, I use closed-end funds, and I use some ETFs. No mutual funds. They're less transparent, harder to see, and harder to understand. Okay, now let's move on. Gains are harder to win back than they were to win in the first place. And it's not unusual for a market to take 2 to 5 years to recover from a downturn. So it's taking you 2 to 5 years to recover from losing the money and trying to get it back. This is why we say, this is why Bogle says, and this is why my research says that expenses cost you 50% of what you were going to save, because in those down years, it takes a long time for those markets to come back. When if you did it right, if you did it in a manner that cost you less, all the way across the board, to buy and to sell, and you got more out of it, dividends with less risk, you are better off in the long run. Believe me. What can you do today? Well, first thing you can do is you can write me at info@Laughing Retirement and say, Chip, I'd like to talk. Second thing you can do is follow that Calendly calendar and book a 20-minute talk with me. You can watch the other videos we've done. You can watch the master classes we've done. You can also be diversified. One of the things I've found over and over again is that people don't know the risks they're taking. If you go to the healthcare sector, the utilities sector, and the consumer staples sector, you will lower your risk because those sectors have the lowest risk, they're defensive, in the S&P 500. Increase your dividends to at least 4.5% with a 7% dividend growth rate so that your dividends are growing at a rate greater than inflation and taxes. That makes you a winner. Sign up for a free 20-minute chat with me. There's no obligation. I'm not going to push you. I'm not going to say, well, you need to do this. What do you think? Come on. No, that's not how it works. This is your money. And you have to decide what to do with it. You have to decide where you are best off. I'm just here to facilitate what I believe is best for most people. If you'd like to learn this, sit down and talk to me. I'll show you how much it is. I'll show you how much it works. It's 60 or 70% less than you're paying right now. And if you want some help because you can't do it now and you'd like somebody else to do it for you before you learn to start this now before a possible recession. Now, I want to thank you very much for spending time with me. I hope that everything we do is designed to help you. Everything we do will give you some insight into what you have. Because I know that retirement is a big change. And I know that what you do with your money in retirement is very, very important. And that's why we're here to help. I'm Chip Stites, and this is the Laughing Retirement.